The McAlvany Weekly Commentary covering monetary, economic, and geopolitical news events.
Government can pretend it doesn't have responsibility for creating the wealth distortion via its wealth effect policies of zero rates and quantitative easing. They asked for the wealth effect. They got it. They just hadn't realistically appraised the landscape to see that a disproportionate benefit would be accumulated, kept, hoarded, whatever you want to call it, and not recirculated through the economy.
Now here are Kevin Orrick and David McAlvany.
Welcome to the McAlvany Weekly Commentary. I'm Kevin Orrick along with David McAlvany. Strangely enough, Dave, you had predicted that the Federal Reserve would probably delay raising rates. You, Jim Grant, there were some voices out there that said they can talk all they want about the economy lifting off, but as far as the lifting of rates, they're looking at the real numbers, aren't they? And they're not seeing growth.
And this is what we're going to look at today, not only in the U.S. context, but around the world. Central banks are basically saying one thing and doing another. You had Jack Lew, head of the Treasury, who said that the U.S. economy is very strong here in recent days. And yet, again, we have the latest from the Fed that an early liftoff of rates is unlikely. We've got the Fed persisting in keeping the patient on the IV. And if you think about that, it does suggest concern about sustaining any form of growth outside the extraordinary interventions in place from the Fed.
Okay, the theory behind this massive monetary and interest rate accommodation, what we call easy money, the theory is that people are going to go out and spend that money. It seems, however, that people aren't spending the money. They're cautiously saving or paying down debt, aren't they?
Well, that's right. So the theory failed. And the more recent idea that a drop in energy prices would inspire the consumer to spend like it was 2006 also has failed to materialize thus far. Consumers, as you suggested, are choosing to pay down debt. That's been the actual response.
Right.
And I think that's the smart thing for consumers to do, which is unfortunately what the Fed considers to be a waste, because what they want is for every dollar to be in the system and to be multiplied. They don't want a reduction of dollars in the system.
Well, and to be fair, there are areas of growth. Now, it may not be healthy in the long run, but let's face it, look at the stock market. For the past 15 years, the NASDAQ has been below the levels that it hit in the year 2000. But, the NASDAQ is poking back at those high levels that it was at before.
Well, right. And, when something goes into a bubble mania, it's not uncommon to see a generation go by before that asset class is in recovery again. Certainly, we have yet to see the recovery occur, say, in Japanese equities. And we've had decades. Now, of course, off of the lows of, say, 7,000 on the Nikkei, it has done very well, but it's still less than half of its previous value. So, yeah, we've got the S&P soaring. We've got NASDAQ, which is just a stone's throw away from its old highs. And as Robert Schiller over at Yale has said, the valuations that we have today are a declaration of danger for the long-term investor. So, equities have been very sensitive to the extend and pretend policies of the Fed, the print or die policies, which not only the Fed but other central bankers have implemented. So that's the first area of growth we've seen in the last 3 to 5 years.
It's interesting. The areas that took the most devastation during the real estate collapse, I'm thinking of southern Florida real estate. We all know jokes about, Florida real estate. It used to be swampland, but actually any Florida real estate was a problem during the financial crisis back in 2007-8. But that seems to be an area of the greatest growth at this point.
And it's funny, I think you could write books on the bubble dynamics of southern Florida real estate, because actually going back to the 1800s, you had your first major bubble in South Florida real estate. But today, South Florida again, along with California and Hawaii. And at present, you've got in the planning stages or actually being constructed, again, this is in South Florida, 350 new high-rise condo buildings which are in the works. And to me, that seems reminiscent of the 2007 boom, which at that point had 30,000 condo units under construction. Of course, that was as real estate was reaching its frenzied stage.
But from what I've read, Dave, a lot of that money's coming in from outside the borders of the United States. It seems like it may be one form of flight capital into the dollar, only instead into these assets here in the United States.
Yeah, and depending on what the region is, I mean, you're seeing a lot of Chinese buying, certainly in California and Hawaii. And South Florida has always been a mecca for Central and South Americans, and of course Europeans, Russians, etc. But just a few years ago, if you looked at Vancouver, Canada, you were seeing nearly 75% of all real estate transactions coming from Chinese. And in Honolulu, the numbers are similar today, certainly well above 50% of transactions being done with Chinese. And this is interesting because this is flight capital, which is on the move.
You know what it reminds me of? Remember Min Pei, who we had on the show, who was basically saying the elite in China find ways of walking out with the dishes, basically, and the silverware.
Yeah, and that's the vested interests that he described in China. They're being purged. Why are they being purged? Because before significant economic reforms are implemented, and it's even possible for them to be implemented, they need to be pushed out. So, yep, Min Pei, he joined us a couple years ago. We explored the power of the political elite and those that have thus far benefited. If you look back over the last several decades of growth in China, these are the folks who you might say cherish the status quo because it's been so good to them. And their world is changing. Those vested interests are being pressured out to make way for the implementation of the third plenum agenda and what is slotted to be significant wealth transfers guided by the Chinese Communist Party. You've probably seen in the last week or two the New York Times articles, the Wall Street Journal articles, which have highlighted the property ownership, particularly in Manhattan, of Russian, Eastern European, and Chinese. These are sort of your $5 to $15 million properties, which are owned, and they set them up, owned by a series of trusts so that it's sort of privately owned. And it's basically treating the U.S. as a mattress for foreign money.
Well, you know, Dave, in October when we were in Argentina, we noticed that the poor have to find a way to get their pesos, which are devaluing, turned into U.S. dollars. You know, a $100 bill was very, very valuable. In fact, it was twice as valuable as the government said it would be at the time. The medium or the middle class would buy gold, okay, silver or gold. But actually, the upper class, silver or gold, wasn't going to do it completely for them. They actually bought properties. Remember that? Apartment buildings, that type of thing, to get into something other than the currency. Now, are they doing that to get out of their currency into another country, in this country?
Yeah, and it's interesting to note that the currency turmoil in the rest of the world is inspiring a shift to select U.S. cities. You're right. You remember the gentleman down in Argentina. He preferred apartments in downtown Buenos Aires right along the main streets, considering them to be a much better storage of wealth than, say, bank deposits.
Right.
And it's really a modern phenomenon that we have so much confidence, both in Europe and in America, in not only central banks, but banks and the banking industry as a whole. The rest of the world, particularly where there's currency volatility, will look at that as a very vulnerable place to be. So not surprising to see safety deposit boxes filled with U.S. dollars in Argentina. On a relative basis, the U.S. dollar much better than their home currency. But yeah, it's interesting that the drive to U.S. real estate is, again, an expression of angst, an expression of turmoil, resulting from the devaluations, so many of them around the world, orchestrated by the world's central banks.
Well, and what else do you do if you have assets, Dave? I mean, look at how many countries right now have negative interest rates. When I try to explain to a client that if they were to buy a bond in Sweden or if they were to buy a bond in Switzerland, they actually would pay interest back over the duration of that bond instead of getting paid interest.
And the only way that makes sense is to ignore the interest rate altogether and say, I so expect apocalypse in other currencies that I prefer a negative rate, knowing that I will have a positive rate of return given the appreciation in that currency, that safe haven currency. And again, there's multiple themes here. One is that I don't like other currencies so much so that I will accept a negative rate, knowing that the currency gains offset. I mean, think of that dynamic, if you will, and keep in mind that this is now the routine. We have central banks, which are surprising, announcing lowering of interest rates. This year so far, we tallied 20 different central banks announcing a lowering of rates and surprising the market with the announcement of a lowering of rates.
Aren't they doing that to stimulate the economy? I mean, they're openly admitting that this thing is not restarting if you watch their interest rate decisions. And yet on paper, when they're quoted in the papers, they're telling everybody that everything's fine.
Well, that's the point. In terms of global growth, what you're seeing, what central banks are doing is very telling. They're lowering rates in order to stimulate growth when stimulation of the economy is needed because, quite frankly, natural growth is non-existent. So this is a broad base, 20, which represents a very diverse geographical mix. And so today you have a total of about 16% of all sovereign debt that is owned by an investor at a negative rate of interest.
16% of all sovereign debt is now paying negative rates.
That's about $3.6 trillion of negatively yielding paper. And again, this is investors voting with their feet in one way or the other. You can talk about properties, you can talk about people accepting negative rates, but you only accept negative rates in light of the alternatives. And this is where I think you're beginning to see multiple versions of flight capital. The lowering of rates below zero is a sign and symptom that growth is not happening fast enough in many economies. It's not keeping up with the exponential growth in liabilities, and therefore stimulating growth. Central bankers are seeking to do that by stimulating inflation. This is sort of an economic axiom, not one that I hold to, but there is this belief that inflation goes hand in hand with economic growth as long as you keep inflation at a low rate. So you've got targeted rates of 1 to 3%. And, quite frankly, you look at the commodities complex today, and it's suggesting that you do have broad-based weakness in the global economy. Copper is weak. Iron ore is weak. The industrial metals are signaling that there is slower global GDP growth on the horizon.
I think it's important to point out, Dave, that deflation itself is not a bad thing. If you are out of debt and you're watching asset prices fall, all it means is you're able to buy more with the dollar that you have. But deflation is absolutely a killer for the person who is in debt and can't service that debt. And that's what we're talking about right now.
That's one of the critical differences between the current context in the 19th century, where there was economic growth. At the same time, you had deflation. And you're right. The challenge today is that there is too much debt in the system, and therefore deflation takes on a negative element. Keep in mind, the debts are owned in large part by the financial operators, and none of those financial operators wants to take a loss on those debts. I mean, what is a debt except a loan that you've made? You want your money back, and you want interest along the way. So to you, debt is an asset. But this is the problem. In an environment where there is deflation, having too much debt puts a tremendous amount of pressure on the leveraged operator, the financial institution. And quite frankly, I guess you could expand that list because it's not just the financial operator today under pressure. It's the household with too much debt. It's a corporation with too much debt. It's developed world governments along with the financial sector that have too much debt. And that's one of the reasons why. I mean, you see everything that's happening in Europe today. The concern in Europe is because there is too much debt that you might have a massive ripple effect if it's not handled well.
We use the word interest rates, and sometimes people just have a blank stare, but actually what it boils down to is the cost of money. And if you can control the cost of money, you're protecting one group or another. You're either protecting the debtor or the asset owner. Okay? And unfortunately, if you are a debtor with interest rates at this level, you are in trouble because deflation is kicking in. Aren't they protecting the asset owner at this point?
Well, in this case, the largest growth in terms of assets has been in leverage, if you will. For 30 or 40 years, we've seen an increase in debts. Okay. And so the banking industry has helped by being a purveyor of IOUs in the process of expanding this quote-unquote asset class. And guess who's defending the banking industry? Central bankers. I mean, that seems fairly obvious, but when you look at interest rate policy, which is set by the central bank, who are they defending? Central banks defending the banking system, which they are sort of at the apex of, Interest rate policy is one way of protecting the owner of assets. That is, the owners of businesses and, of course, the banks themselves. So, I mean, first of all, you've got, by lowering interest rates, you're in essence recapitalizing banks with the interest dollars that would otherwise have gone to the depositors. And then second of all, you've got a lowering of interest rates, which also inflates and keeps elevated the prices of assets that would otherwise move in a cyclical up and down. Now, I mean, by up and down, I'm talking about the normal business cycle, an ebb and flow. Interest rate policy, in essence, is the Fed choosing who will pay the costs of adjustment for the debt accumulation of the last 20 to 30 years. And I think that's critical.
So when we had asked ourselves all these decades, Dave, all of our adult life, who's going to pay this debt? Because we continue to ask the question, when does the day come that this debt actually comes? And I'll be honest with you, I think most of us think, including myself, in these one-day massive catastrophic collapses. But actually, what we've seen since 2008 is financial repression. We're talking to people all across the country who tried to retire on their money, earning interest rates that are reasonable on their money. And that's been directed actually to the people who the Fed and other central banks are trying to protect. So the cost of the debt that we've accumulated over the past 20, 30, 40 years is being paid. It's just not being paid by the people who should be paying it.
Well, that's right. What we've described as the magic 5% is today the elusive 5%. In the news, of course, is Greece and the machinations in Europe today. And the question there, the only question, is who will pay the cost of adjustment. A financial crisis is, as our commentary guest, Michael Pettis, suggested recently in a Financial Times article, nothing more than assigning losses. I mean, that's the way that you resolve a financial crisis is by assigning the losses. And that, I think, is the simplest expression of what is happening in Europe today and around the world. There are really only two options. Either the owner of assets takes a hit, and debt, as we've mentioned, is considered an asset to the bank or lender. Or option two, the middle-class household or working class take the hit.
And that's what's happening.
So far, it's the worker. So far, it's the middle class that via a combination of low wage growth and financial repression, that is, rates being kept at the zero bound, they're paying the prices. And I think governments would like to keep it that way, with banks and elites protected from losses on their own balance sheets. And with the message being very clearly that it's not central bank policy, it's not interest rate policy that is in any way connected to what is occurring. The beauty of financial repression is that it's an obscure idea, just like inflation. As Keynes said, the reason why it's a preferred method by politicians and ultimately central planners is because not one in a million understands it. So it allows for politicians to do what they want to do without getting caught.
Well, and let's face it, even Congress. Yellen is going to talk to Congress this week. Most of them don't understand what she's saying, okay? They think that the Fed is there to help. You know, the old saying, we're the government, we're here to help. Now it's, we're the Fed, we're here to help. And I think the sad thing that we're seeing, though, Dave, is people right now cannot make ends meet based on this financial repression. But it's been sold based on security. In other words, people don't want to see things change, and they've been told that the only way to restart this economy is really to do what they're doing.
Well, it's the same thing with Homeland Security. Homeland Security is sold as a concept because we live with now a basic level of insecurity. And notice we're about to run out of funding for Homeland Security. And did you see how conveniently the Mall of America is under attack?
My wife said the same thing. She said, look at the timing of this. You know?
Yes, we're almost out of money. And Mall of America, don't you know what's going to happen to the economy if the consumer doesn't show up? I mean, this is so much kabuki theater. It's almost silly. And I wonder if the average American looks at this and says, do you see how the news headlines are orchestrated? Back to the banks, because I find myself conflicted on this issue. I don't have an axe to grind with banks or financial institutions. I don't see the sector as inherently evil, but I do see that their propaganda machine has very effectively inspired both the political right and left to bail them out.
Right.
And again, because there's this idea that if you don't bail us out, don't you know we'll return to the financial dark ages? So the propaganda machine has played off the fear of the unknown, and as a consequence, you've got politicians at the beck and call of financial VIPs. So this is where we now have a new class of businesses in America. And this, again, didn't exist before the global financial crisis. But we now have the systemically critical enterprise.
Almost too big to fail.
Well, that's exactly right. We can't imagine a world without these institutions, and the loss of them would be far too disruptive.
So let's face it, though. Okay, the reality today is interest rate policies are protecting special interests.
Precisely. Now, I mean, you've got financial entities and the largest owners of assets, which are protected by interest rate policies. And this is the primary cause of the gap between rich and poor. For all the political discussion of an income gap, I mean, keep in mind, it is interest rate policies and it is the Fed which has created this. Again, I don't have an axe to grind with the super wealthy or the semi-wealthy. I don't have an axe to grind with the talented surfer. I mean, think of this. If you line up the perfect wave and carry the wave from out in the ocean onto the shore, being at the right place at the right time, there's nothing criminal about that. However, what I object to is the notion that government can pretend it doesn't have responsibility for creating the wealth distortion via its wealth effect policies of zero rates and quantitative easing. They asked for the wealth effect. They got it. They just hadn't realistically appraised the landscape to see that a disproportionate benefit would be accumulated, kept, hoarded, whatever you want to call it, and not recirculated through the economy.
Well, and let's look at who has the assets, Dave. I mean, he who has the assets is appreciating right now. Right. I mean, he's appreciating his stock prices rising. He's appreciating his Florida real estate rising.
Yeah, and who has more debt than assets? Now you're describing the middle class. You're describing labor. So, I mean, rather than acknowledge that policies are creating a future political nightmare of wealth redistribution, which I comprehensively object to, central banks are increasingly joining the parade all around the world of low to zero rates, and they're using this as a new mechanism, a new means of modern-day currency devaluation. And I guess because everyone's doing it, no one seems to be concerned.
So it's like many illusions, Dave. You can really make it pervasive if everyone's doing it. I mean, there must be nothing wrong with it if everyone's doing it. You've got every central bank in the world right now lowering rates, it seems.
And on that basis, you had the global devaluation of currencies in the 1930s. And I'm sure that was reasonable then and should be now in retrospect, if in fact it's just a question of lining up a parade and everyone does it.
Well, let's go back to what Michael Pettis said, because assigning the losses, that's a scary thought, because it sounds to me like somebody has the power to just go ahead and say, you lose, you win. It really doesn't matter how you played the game up to that point.
But isn't that what's being negotiated in Greece? I mean, You want a haircut taken. I mean, this is what Syriza wants. They want to cut the total stock of debt in half. And yet you've got the creditors in Germany and in other northern European countries saying, we lent you the money and we expect to be paid back in full. And again, this is an exceedingly insightful prescription for financial crisis from Michael Pettis. Assign the losses.
Right.
You're done with the financial crisis as soon as you've assigned the losses. What you have in conflict is self-interest. On the one hand, you've got labor. On the other hand, you've got capital. And in that same article, he suggests that the imbalances between Germany and the peripheral European countries, they're just too simplistically and inaccurately characterized as in the North, the thrifty North, the financially responsible North, the savers, versus the spendthrift, I've got a credit card and I'm going to use it South.
And I've been guilty of that, Dave. It's much easier to try to simplify something and just say, look, the Germans were better with their money. The South was spendthrift. But really, if you look at it, these people were actively and knowledgeably playing for something that really needed balance. And the Germans were going for the low labor costs of the South. The South was taking those great loans from the North as far as the low interest rates. And so everything was out of balance as it came together.
What Pettis argues is that there is no political conflict in Europe today, or there shouldn't be, because what you're dealing with is different economic interests. So he points out that labor wage agreements that were made in the late 90s in Germany, which increased the profitability of German firms at the expense of labor income. And in so doing, created a massive amount of savings in the North.
Because they were saving on labor costs.
Well, right, which again increased company profitability, where did the cash go? With increased profitability. Mm-hmm. He argues compellingly that the savings glut from Germany was and is equally responsible for the debt frenzy the South engaged in. So think about this. You've got banks brimming with excess savings. It is then lent to the peripheral countries.
Which they were happy to take those loans because this was the lowest interest that they had paid in years.
Well, exactly. It fed the appetite for cheap loans. You've got lower rates following the inclusion into the EMU. We talked about that a few weeks ago. And then now you've got access to credit and lots of it. So this ended up feeding the asset bubbles in Spain, Italy, Portugal, Greece, and Ireland. Who's to blame? The person not qualified to take out a loan that receives one anyways?
Right.
Or is there a shared culpability between the creditor who's making a bad loan and the debtor who's taking on an obligation he knows he can't pay?
Didn't we see this with the subprimes here?
Both had a choice.
Yeah.
Both exercised the choice with eyes wide open, as is often the case in lending. When there is a trend beginning, again, sort of excessive lending, bankers fear losing market share if they stay out of a lending frenzy, and thus they are willing to lower lending standards to keep up with the competition. So, no, it's not just the spendthrift South that holds responsibility. German politicians chose to disadvantage German labor in order to increase export competitiveness in the late 90s. Politicians gained thereby a stable labor pool because you're dealing with a very low unemployment rate. And guess what? They financially shifted away from labor, a benefit from labor, to the owners of capital.
One of the things economists love to do is talk in equations because they can talk ambiguously because they know nobody understands the equation. But Dave, this is a simple equation. Germany has the capital surplus that is lacking in the South, or the North has the capital surplus that is lacking in the South. The balance shifted is what you're saying.
Exactly. So your current account does balance. If you have a positive on one side, you've got a negative on the other.
That's an equation.
That's an equation. And the effect was to create a current account surplus in Germany, which is matched mathematically by the deficits run in peripheral Europe. So this is where you're dealing with Germany being complicit, having gained an advantage over the last 10, 15 years. And you can't at this point say, well, we gained the advantage and we were willing to lend our capital, put it at risk, but we're not willing to take a loss on the capital we put at risk.
Okay, but let me ask about Greece. Okay, because we've talked about it the last few weeks, the game theory, all the play that's gone on, but, they've been granted an extension. How many more extensions are they going to get? And actually, what is the extension for? Who benefits?
They haven't solved anything. They've basically said it's going to take us a little bit of time to work this out. So we're going to, again, sort of go to the extend and pretend. We will work this out. We're making headway. I think it's very interesting, Kevin, that through the weekend, you had very acrimonious language. And basically what happened on Friday is that they were granted a 48-hour extension. They were asking for 6 months and they were given 2 days. Okay, so
it's the old line in the sand. Yeah. It's here. No, it's here.
Yeah, and so they were given 2 days.
Right.
And then all of a sudden, 2 days later, Greece is signed on and 4 months is what's in the bag. What happened over the weekend? Who called whom? And quite frankly, what we do know is that nothing has been resolved or agreed to at this point.
But if we were to weigh the equation out, let's call one side capital, let's call the other side labor. Okay, right now it seems that capital is winning.
At the expense of labor.
Right.
You've got the financial sector throughout Europe. And yes, that financial sector throughout Europe is defended by Mario Draghi at the ECB. And they're loath to concede a loss of the principal loaned out. So the conflict will continue to rage. Will they get a third bailout June of this year? Or ultimately, will there be a percentage debt forgiveness? And again, it goes back to this concept of assigning losses. Who will accept the losses in this financial crisis? Let me clarify something, because by using these sort of broad categories to summarize the issues in Europe and in Greece, labor versus capital specifically, I'm not adopting sort of a soft Marxist critique. I belong to the capital side of the equation, but I think it's important that you bring self-reflection, self-critique, and objective observation. These are all valid, even if at points in the conversation there's a bit of uncomfortability. Having capital is not wrong. Having assets grow by any means, including artificial ones. Listen, if you're experiencing it, you're not going to object to that. While that's pleasant, keep this in mind. Artificial growth may, however, have very serious long-term ramifications. And that's what demands analysis and critique.
Well, and I think that's the key, Dave, because, a Marxist would actually say that's exactly right. Capital's beating labor, so you have to balance things out with communism. But in reality, it's the ability to create artificial stimulation and artificial retraction and basically choose the winners and choose the losers. That's not free market. That's socialist control. It's just another form of communism.
Well, insofar as it has command economy characteristics, that's precisely it. It's the artificial nature of growth that I have a problem with. And to me, it seems that there's too many political legacies and agendas served by eliminating the business cycle and introducing artificial growth stimulants.
Well, going back to the equation formula, though, Dave, there's another equation. There's the haves and the have-nots. Okay, it seems like it always comes up in any political discussion, any economic discussion. What groups of people do you have in modern democracy?
Well, that's it. I mean, along socio and economic lines, you can simplify it to haves and have-nots, and you'll notice that politics plays to one side or the other of this divide. Politicians focused on labor, they know the difficulties of remaining in office. Let's see. If you neglect the basic needs of your constituency, if you get caught assigning losses to your constituents, that is, get caught, you can do it, but you just can't get caught. Or if you play too heavily to the benefit of the owners of capital. And I think, frankly, that's where Hillary in the 2016 election, this is going to be her curse. She has played too heavily to the benefit of the owners of capital. So if you're looking back in time, austerity and belt tightening hits households the hardest.
Well, and what's interesting is austerity is the most dangerous thing for a politician to choose. I mean, it may be the right thing. Let's go ahead and tighten our belts.
But history provides a number of examples that suggest there is a pain threshold, whether it's in the middle class or amongst labor, what have you. Think about the Romanian experiments with austerity under Ceausescu.
Yeah.
Ultimately, he and his wife were murdered.
Right.
You saw the same outcome in Czechoslovakia. The head of the treasury was Alwa Racine. Who cares about Alwa Racine? This is sort of 1920s, right? Too much austerity and pain, and the people revolt. Racine was assassinated.
Yeah, but the party that's in power right now in Greece has chosen the easier method. It's like, hey, no, we're not going to pay our debts. In fact, you want retirement in the 50s? That's fine. Take retirement in the 50s. We're not going to cut anything.
In fact, you deserve a bonus. No, so Syriza in Greece, they were elected with the mandate of making capital take its lumps. And I mean, if you think about that, that should be a part of the capitalist equation. Right? It was cutting the burden of debt and avoiding more radical austerity measures, which were their election mandate. And that's the direction that Syriza is heading. I mean, remember that no economy can grow if it has too much debt. And this is one of the reasons why the folks at PIMCO, there's a number of economists, probably half a dozen to a dozen different Wall Street companies that are saying you're going to have to lower your expectations in terms of global growth, in terms of U.S. growth.
Because the debt is huge.
We have so much debt at this point that the servicing costs sap the resources needed for growth. And so you could argue that the best route forward, in the case of Greece, is in fact to cut the burden of debt by some percentage. And if that's done, let me say, I stand corrected from last week. If that's done, then those growth-linked bonds, which I was ridiculing last week, they would work. You have to reduce debt to the point where, again, the burden of debt service is not sapping all the potential energy for future economic growth.
Well, and this sounds obvious, Dave, and hindsight is 20/20 for all of us in all of our lives, but in governments especially here. The better thing would have been not to take out the debt in the first place, would it not?
Well, that's right. And that's where, we don't really, in the U.S. or globally, have a system of accountability for government spending. In fact, if you put government on sort of a limit, let's call it a balanced budget amendment here in the United States. Politicians don't look at that as we get to spend less. That means we get to tax more. I mean, the solution to a balanced budget amendment is that we balance the budget by picking your pocket that much the more. We haven't quite figured out how to control governmental largesse. But if you recall, that period of 1860 to 1914, the golden age, the period where the world was on the gold standard, this problem of governmental spending largesse, it was solved by the monetary system itself.
The equation balances itself when you're on a gold standard, Dave. I remember when the ship, what was it, the USS Central America sank with San Francisco gold on it. It actually created a depression in America because that was a monetary loss.
It was a monetary
They couldn't just
loss.
print it out of thin air.
Yeah, so I mean, it's certainly the case that avoiding the level of debt currently in the system, that would have been solution number one. Just avoid it from the get-go. We wouldn't have the present financial crisis because we wouldn't have as much leverage in the system. That was not done. So setting that aside, we have to remember that it takes two to tango. Lenders were happy to lend. Borrowers were happy to borrow. And I think it reasonable that both parties bear the burden of adjustment. Some austerity, but not so much that you ruin a socio-political peace, and some debt absolution, which is in effect taking it out of the hide of the banks which facilitated an overabundance of subpar lending. And guess what? They did profit from the debt issuance in the first place. I consider it an axiom of capitalism that capitalists put capital at risk. You should not then go hide behind the skirt of a bureaucrat or a legislator when your bet goes bad.
Well, and capitalism is about taking risk. The only way the system gets healthier is with creative destruction and innovation that comes afterwards. I mean, if you don't have the creative destruction of the things that are not working, what you're really doing is you're just feeding the cancer that will continue to get bigger.
So essentially what we have in Europe is a massive influx of dollars in a 5 to 10 year period. And that massive influx of money, not dollars, euros, of course, but I'm talking about currency units, came from Northern Europe, came from Germany, as we talked about, the difference between labor wages, which were set artificially low in the late 90s, and it created a massive influx of capital from those countries into the peripheral European countries.
We seem to have a historical precedent for that. You know, years ago, Dave, Drew, our coin buyer, was able to attain some first edition German marks from 1870. And these were marks that were minted from French gold that was extracted. It was the French indemnity, basically, when Napoleon III lost a war to Prussia, later Germany, in 6 weeks. They had to pay, I think, 43 million ounces of gold into Germany. And Germany, which was Prussia at the time and it turned into Germany, they minted the first Deutschmark. And, you know, what's interesting is that was a huge, talk about a massive movement of capital, very similar to what we're seeing here.
Well, and think about what happened in the last 5 to 10 years in these peripheral European countries. Stock markets went crazy. Real estate markets went crazy. Everything went higher, again, because of this influx of capital. And the same thing happened in Germany. If you get a chance to read Pettis's article from the Financial Times, it's excellent. He mentions this, and it's, I think, a critical historical reference point. French indemnity, the money coming into the peripheral European countries, it was similar in scale to the 5 billion German gold marks that were coming into Germany. And guess what happened? The Germans experienced a major asset price explosion after the Franco-Prussian War, ending with sort of a blow-off phase in 1873, a collapse in the stock market in Germany. And ultimately, this had ripple effects throughout the world. This was the first experience of the New York Stock Exchange in 1873 as a consequence of the blow-off and ultimately collapse in asset prices in Germany. The New York Stock Exchange was closed for 10 days.
Wow. You know, you don't hear about
for
that.
10 days.
Yeah.
So, you know, you had 20 to 23% of GDP, which was the amount of the reparations paid from France to Bismarck's Prussia. The result was the same. Asset price explosion, followed by asset price implosion. And this is what we're trying to address here in Europe and all around the world. The real lesson is that massive liquidity coming into any economy is disruptive and ultimately dangerous, because on the one hand, it inflates asset prices. And then what follows is typically the deflation of those assets. We've had a long-term increase in debt liquidity, which has fostered the increase in global asset prices for 20 or 30 years up until 2008. And now on top of the old debts, we have new government debts, which were introduced as a means of propping up the old asset prices, the unsustainably high asset prices, at levels they reached again before the global financial crisis.
Well, then let me ask you a question. Okay. And this was the title of a book that we've recommended in the past. What would make this time different? Okay. They say this time is different, but really the whole concept is there is no time that's different. It always ends up the same.
Well, perhaps the degree to which central banks around the world are coordinating efforts. I mean, that is certainly different. Perhaps that continues to buy us some time. But as Pettis has suggested, at the end of the day, the only solution to a financial crisis is to assign the losses. Okay. So as we mentioned earlier, this is a large part of why capital is in flight around the globe. Because you have in multiple jurisdictions people who are growing concerned that they may be required to contribute to the solutions. They are concerned that whether it's legislation, outright confiscation, taxation, what have you, that they may be the assigned loser. And of course, all that's for the greater good, so they say.
You've been listening to the McAlvany Weekly Commentary. I'm Kevin Orrick along with David McAlvany. You can find us at McAlvany.com. McAlvany.com, or give us a call at 800-525-9556.
This has been the McAlvany Weekly Commentary. The views expressed should not be considered to be a solicitation or a recommendation for your investment portfolio. You should consult a professional financial advisor to assess your suitability for risk and investment. Join us again next week for a new edition of the McAlvany Weekly Commentary.